Okay, after the fundamentals, let us listen to our next speaker. He's also not a stranger to us now because, and he continues to be awarded as the best technical analyst consistently for the past 5 years, running by the Fund Managers Association of the Philippines in their latest survey. So let us all welcome COL Vice President and Chief Technical Analyst, Mr. Juanis Barredo. Juanis?
Hello, Martin. Thank you for that. All right, I'll just share my screen with you. Okay. So good afternoon, everyone. Thank you again for taking time to be able to be with us today. We've gone through a very traumatic 2020. Such that certain circumstances we'd never thought that we'd see into our lifetime. And unfortunately, we did have to be able to deal with that and to the consequences of what that can happen. And of course, in the first quarter of last year, it was quite harrowing into the stock market, but at least we did spend a good chunk of that trying to be able to make a recovery. So today we're going to see how the market stands. We did come up with quite a big recovery from the low that we saw. And we seem to be encountering a little bit of some pressure here. So let's review what the technicals have to be able to offer for us and see what type of strategies we should be looking up into the next half year. So I'd like to be able to start by giving you a summary of what I'm going to discuss. And I think that markets began quite well in the beginning of the year. Some of them are still showing quite a number of bullish tones. However, I'm already seeing some markets are showing some degree of fatigue. And the reason for that is either they are overbought or some of them are losing some of the upward momentum that we've seen in the very beginning. And that might proceed into some corrections relatively soon, if not already for some. Now, the Philippine Stock Exchange is one of those markets that seem to be showing that degree of feebleness already. For one, it's hit major resistance. I think it's completing what I call the third wave from an Elliott wave perspective. That could be driving into a fourth wave now. And that possible need to be able to react or to consolidate is something that may be up ahead, and we're going to have to be able to factor into our strategy as we look into our prospects and what we do for equities. And I think what I would be doing is I'd be sitting aside for the meantime, waiting for these reactions to be able to come up so prices come back down to better levels of support. And I want to use that as my next buy window rather than just buying from where we are as of today. But anyway, please join me so I can try to be able to show you a bit more visually as to what to expect. So the slide that you're seeing here just shows you the performance of the Philippine market. You see here on the lowest right side, as compared to what the other markets have done. The Morgan Stanley Emerging Market Fund did quite well so far. It's up 11%. And so a lot of Asian markets and some other emerging markets were included into that index, showing you how substantially up they have been. China's up about 7%. The US or the S&P is up about 3.3%. The MS World Index, which comprises a bigger version of the EMF as it includes more markets except the US. And you can see that they're all actually quite higher so far, except for the Philippines, which has now flattened itself to where we have it. Now look here on the right side, you will see a number of Asian markets. The Philippines is the chart in the middle. And you can see that the Philippines and Malaysian indices seem to be the weakest of them all as of the moment. And the rest of the other markets are still either going strong, like you can see Singapore still doing well, Japan doing well, Hong Kong. But you can see from the red arrows that I've drawn towards your RSI that some of them have already showing overbought conditions or divergences. And what that means in technical analysis is it seems to be losing its speed. And normally when that happens, that's when corrections usually come. So it's something that we're going to have to be able to build in that into the short term. We might experience that little window where prices might need to be able to make a strategic retreat. And we want to be there as an opportune moment to be able to catch them when they come back closer to the support levels that we've been looking for. So to start on the broader scale, let's have a look at the US market because, of course, this biggest market in the world does affect what happens to everybody else. And so far, the US market have been doing quite well. If you can see the chart of the S&P 500, I have two graphs displayed there. The first one on the left side is a daily graph, and the graph into the right side is a weekly graph. I put one there so you can see what the short-term orientation was, and the right side will give you a medium to longer-term orientation, so you can see what the two different types of trending conditions are, and that will also give you better assessment how far stretched a market can be and how far from support it is, so that at least we can try to be able to discern what is our effective risk if we're attempting to move into this market or hold on to the market right now. Or furthermore, in our case, what that risk would imply that if that were to start to correct, what would happen to us? Will we be influenced by it? So based on to the US market, the advance is still ongoing. And I don't think anything major will happen until I see a break of the 20-day EMA, which is this area that you see here on the upper left-hand side. It's about 3,778. And if that level breaks, then we probably will see a wider correction be established into the US market. Now, from history, I don't normally see major corrections coming in January, but normally in February and March, there is presence for certain corrections coming in there. So I think in this first quarter, we might be able to anticipate that there could be a potential wider correction that the US could go through. But right now, with the swing of Biden into it, putting in new policies, the tech companies seem to be holding on to their trends because initially we thought that Biden would be very negative for the tech sector, but apparently these tech companies are still producing pretty good earnings. Not all of them, but at least some of the more viable ones. And I think in the next few days and weeks, we'll probably see a mixed amount of earnings, and let's see how that fares and whether the market can hang on. So if the 20-day moving averages break for the S&P, please expect more wideness in terms of the correction possibility for it. Now, in terms of US bond yields, I'm looking at this because just earlier, a few weeks ago, there was this threat that people were talking about that US yields or potentially interest rates may start climbing already. If you notice the right side of the graph I have there, which is a weekly graph of US bond yields, you will see a potential basing out pattern here where prices have broken free from and surging first, and in the last 2 weeks it seems to be stepping back a little bit, and that's what you're seeing, this small little step back in this area here. So what I think is happening is, yes, I think there is a bottoming effect into yields, and that means I think we've seen the lowest in rates. However, that doesn't automatically mean that you're going to see a strong surge in rates. That could still take some time. So it's quite possible that yields could just cascade first and then maybe wait for the next push eventually over in time. And you'll probably see something more cascading on the way up, but maybe you're not going to be seeing a very, very heavy surge in yield. So I don't think that would be something that would bother the market once this thing starts to be able to calm down. But clearly, I think we've seen the lowest that we have in yields. So for the meantime, we have to be able to build in that this may gradually appreciate over time. Now, in terms of the impact into the US dollar, so the US dollar into the short term has shown some rally. And you can see in the graph here on the left side that a major downtrend line has been broken and that a little bit of a rally has been staged. But again, since this is coming from a major decline, you see the graph here on the right side shows that it is still on a major decline. I think that the pressure to show a substantial rally in the dollar is not going to be there just yet. And unless it breaks through 91 onto the US dollar index, I think we'd probably see something more consolidating in terms of its perspective. But yes, in the short term, there seems to be a potential reversal. I do see divergences shown into the lower part of those areas, and that would tell me that there could be a potential short-term rally into the US dollar. Now, what effect would that have into the peso dollar rate? Well, into the peso dollar rate, it's what's quite interesting here is let's start first with the long-term position, which is what you see here on the right side. You can see that we are still into a downtrend, and that means if your peso dollar is in a downtrend, that means your peso is still gaining ground against the US dollar or gaining strength against the US dollar. And that normally would mean that you should be holding the peso the peso currency as against doing the opposite, which is selling the peso and buying the dollar. Now, one thing though is you can see it's trading on the lower end of the range if you see this downward channel. And it's because of that that you can see a deceleration into that decline that it's been making. Now, I know you might feel apprehensive that the potential for this peso dollar to rally might be there, but I would caution you not to do it too early. So what I would do in this particular case is I would watch the short-term element, which is what you see on my graph on the left side. And if you see that the peso dollar pushes over about maybe 48.13 or 48.20, then that could be able to give you a sense to maybe you should take some profit on the peso first, maybe buy some dollar, wait for the rally to be able to finish up, and then of course reverse your position after that. And the potential for here is if we do see that reversal, there could be a recovery rally that could push this back higher, and I'm looking maybe into a recovery back between maybe 48.53 to maybe 48.94, even maybe even closer to 49. But for the meantime, I don't want to work in too early. I want to be able to the move to be triggered by prices going above 48.13 or 48.20. Now let's swing over to commodities. In terms of gold and oil, now, gold had an attempt to be able to push up earlier on, sometime in December, but towards the beginning of 2021, we did see gold set itself back and see quite a bit of a sharp pullback in prices. So what I think is happening now is that we're probably going to see in a consolidation type of pattern first affect gold. And so do anticipate that you may have to see a sidewinding gesture first into this particular commodity, maybe between the blue line and perhaps the red line. And of course, also in commodities, let's look at oil prices. Yesterday, we had a pretty big decline in that. It was about a 1.6% decline into oil. But I think oil was trading on very overbought conditions. And that's a reason why we did see a bit of profit taking. But the uptrend still persists. And unless I see prices break below $51, oil will remain into an uptrend for the meantime. Now, we are coming from an overbought condition, so we do anticipate a little consolidation or reactive movements in oil for the meantime. Okay, let's swing over to the Philippine market. Now, into the Philippine market, when we look at the longer-term picture of this, we want to be able to show you that we do have a completion of a major corrective wave, which we saw between 2019 and 2020. Now, if you see in the chart I have here, we see a very big decline, which came from about 9,000, fall back into about maybe 7,000, rally back to 8,250, and then all the way back down to closer to 4,750. Now, this is what we've tagged as an ABC correction or an Elliott three-wave correction. And normally after that, corrective waves usually end. Now, after that, we get a significant rally. Now, one thing I want to be able to point out about this particular rally is as such. So if you see the chart that I've just pulled out here on the right side, you will notice that the rally that we've seen since March, April of 2020, all the way to where we are today, which is after hitting a value closer to about 73, almost 74 intra week, we've seen prices attempt to be able to come back down. Now, you might ask, why are we encountering some pressure here? Well, the reason for that is because we're seeing major resistance at about this range, somewhere between the 7,400 and 7,600, or let's say 7,500 area as a substantial resistance zone. Why do I say that? Well, we do have a major downtrend line standing here. We also have the extension of this rallying trend line, which was broken into a decline also there. Similarly, also, we do have a Fibonacci retracement, which is on the 61.8 level of this entire decline, also standing in this area. So you've got three reasons to anticipate technical resistance at this zone. And it seems only likely that prices, after making or staging a comeback from 5,800 to about 7,300, is now undergoing a temporary correction. And I feel this could be a potential wave 4 effect. And so prices may need to be able to react or consolidate for the meantime. And we'll talk about what the possibility of that correction is. So going back into the shorter term picture of the PSEI, again, let's have a look at it. And maybe some of you who follow my tech spotlight see that I draw this almost every day. And you would see now in the latest update that we've seen prices attempt to be able to back off already to the 50-day exponential moving average. That's this area right here. Now, to me, that's a critical short-term support area. So if that 7,000 area breaks, then there's a potential for the market to be able to invigorate its decline a little bit more. And that could potentially push the index back maybe between a range of first 6,750 or 6,660, or possibly even go back to the range of about the 6,400 ranges. Now, if you can see, I've identified that area with these two blue arrows, and potentially if it goes wider, maybe somewhere closer to this area here. Right now, it's very difficult to make that assessment which one it will do because we are coming from a consolidation, and I see some divergence into momentum. The MACD also telling me the corrective process is still taking place. And as such, we just have to be able to make sure that we take the necessary defense for the meantime. Either you stay light or you lighten, and let's see if the market can hold here or not. If not, you want to lighten a little bit more in preparation for the ability to buy back at those level of support that I mentioned earlier. Now I'm going to show you a longer term picture again of this. I wanted to show you a 3-year picture of what happened to the PSEI. And the reason I wanted to show you this is because I've noticed that sometime towards this part of the year, in the last 3 years, we have seen quite a number of turning points. And since we began the year moving upwards, and when I say turning point, that means it normally runs contrary to what you've seen just before that turning point. So in what you see here, the graph is showing you that in 2018, some about January to Feb, the market turned around from a rally and attempted to make quite a big of a strong reaction. And it was quite severe in this particular case. And then in 2019, what did we see? Again, towards the beginning of that portion, in the beginning of the year, it actually started climbing. But after that, it turned around and went into another corrective move. The only difference is this correction took more of a consolidation type of pattern. So it wasn't too striking on the way down. And then in 2020, as you know, of course, because we were plagued by the pandemic which took place, we saw a strong reaction again during the same time, that's January to Feb, and we saw a much more larger condition come to it. Now, we are now in 2021, and we're coming from a major recovery. We've started the year a little bit on an upside, and here we are again on that same period that we've seen in the last 3 years, a typical turning point. And so my feeling is that in the last 3 years, we saw first a strong reaction and then followed by a consolidation, then another strong reaction. So normally markets tend to alternate in the type of movements that they generate. So if we've had a strong reaction in the last one, it's quite possible what we're going to be seeing next could be more of a consolidation type of a correction rather than, of course, a major market plunge. So I hope that that should be able to gear us up to be able to look for that opportunity, because if we do get to buy at the lower end of a consolidation, it should be able to give us good gearing, and it shouldn't take too long to be able to exercise that. Now, in my previous 2 outlooks, I've been using the German DAX as a particular example for that our PSEI index seemed to have been following. And I picked out an example I showed in 2016, and I'd like to be able to continue doing so in today's session. So if you look at the German DAX, the chart I have here on the left side, we are somewhere over here into where that picture is. So this red line you see is roughly where our market is. And I will just draw the Philippine index right here on the right side now. And I'd like you to compare the swings that I've been trying to follow along with this sample. So you notice the German DAX. Again, the first part, it generated a 1, 2, 3, 4, 5 wave on the way up. On the 6th process, sideways market. Let's look at ours. 1, 2, 3, 4, 5 waves, and we are now on the 6th process. And so since this area here generated a sideways type market, I would anticipate that we'll probably try to do the same thing. Now, I'm just trying to be able to plot in the potential band, although I put something closer to about 6,600. In my earlier slide, I did say that I think if worse comes to worse, it could even stretch down to 6,400, but I will stay above this area because this is currently where the 200 day moving average lasts, and normally this is a very strong support. If you notice in the picture of the DAX, it managed to be able to hold that. So I'm hopeful that this can also hold. But if not, 6,400 will be the worst case scenario I'm looking for this. But this too tries to be able to predict potential consolidation. Now, when you look at the different types of subsectors into the Philippine market, I know the index looks like it's still turning and you're not too sure. But when you start looking at the individual subsectors of the Philippine market, you will already start seeing the evidence that these consolidations are actually starting to show already. So if you notice, the services are showing similar type of consolidation, holdings doing the same, maybe the mining not so evident yet, but the financials, yes. Property are showing a bit more weakness as they're really touching their 100-day moving average. And if you notice into the commercial industrials, it's also doing the same. So these two, the property and commercial industrial, seem to be the weaker sub-indices into our market now. I've also took the liberty of putting out the top 5 companies that make that index. So at least you can get a good bellwether. What are those 5 companies that's driving that formation? Because majority of the movements are pretty much done by them. So each one of the sub-index, I put all the top 5. So that way you know which are the issues that are actually being, in this case, stopped by, of course, the consolidation that we're seeing. And finally, I want to also point out a certain thing about the market in general. Let's talk about foreign flows. Now, I think foreign flows into our market has been absent. I know earlier Marvin pointed out that potentially maybe foreigners could actually lift our market, but unfortunately, of what I'm seeing as of yet is they're actually exiting, not coming in. And if you see the last 30-day activity, it's actually become more intensified. And that also contributes to the fact that why we probably see a correction or consolidation into our market. Now, you might be wondering, though, that how can that be? I mean, the market has actually been showing pretty decent amount of trading volume. And yes, we could be getting somewhere between 10 or 11 billion in active volume every day. And that's not so bad for a market. But the problem with that is, yes, we're taking that volume, but I'd like to show you my next slide's discovery. So yes, we're taking this volume, but where is that money, or where are those funds going? And unfortunately, the first slide I'm showing you over here shows exactly that. The orange bar tells you that majority of the stocks that are taking in the volume are non-index stocks. And if you were to look at the ratio between the index stocks as compared to the index stocks, which is here in blue, as compared to the non-index stocks, you're talking about 71% of that funds are going to actually smaller caps, which are non-index based. In fact, if you look at the second stat that I have here, you will also see it quite clearly that in terms of market activity ratio, and that's almost similarly to what you're seeing on the other side, but it also shows you the difference between index stocks and the smaller cap or medium caps that are not into the index. And it's also showing between 64 or 36% difference in terms of an activity ratio. That means only 36% of index stocks are getting the volume, while 64% are actually getting the bigger chunk of the market. And to me, that's what I call flight from quality, because you're getting funds going from blue chips and going to more speculative type stocks. Not all of them speculatives, but at least non-index based. And that's hurting the index type of market. And that's the reason you're seeing a withdrawal. And it could also generate the fact that consolidations more likely is to come. And one other stat I want to show you is I took a poll of all the 30 companies that are inside those index stocks, and I did a quick technical review of each one of those particular companies, from Ayala Core all the way down to URC. And if you notice how many I've outlined in red, that when I put that in red, that means their tendency is to show more corrective signs rather than rallying signs. In fact, if you were to look at the indications I have below, 17 index stocks are clear corrective trends. 7 more index stocks look like they're bending more now. And right now, if you were to look at how many issues I have, maybe in color black, that's 1, 2, 3, 4, about maybe only 5 or 6 left. and the rest have showing all MACD sell reads, and that all tells us that the technical reviews for many of the blue chips are on a corrective sway already. And so that again adds into the pressure. Now, one more thing that I'd like to point out is none of those index stocks are yet oversold. And so that means they're starting to correct, but they've not exaggerated their declines yet. So that means there could be some room for them to be able to back up. And so without any oversold signals, that means there could be some declines that we can still see, and rebounds, maybe that will still take place a little bit later. So I hope that putting all these stats together will help convince you that the market's corrective sense is still there. So in summary, I mean, although the US market shows its resilience, there are some markets that may really need to correct soon. Ours is already starting to show that. I'm quite wary of some other markets showing overbought signs and the trend fatigue, as I pointed out earlier. And the PSE clearly is showing momentum flaws as they are right now. And of course, the rise of what I call these new incredibles, which are the speculative stocks, are stealing the market's thunder and drawing necessary volume away from the the backbone of the market, drawing that move from flight from quality issues into more speculative ones. The worry I have over that is if these people trading those speculative stocks get caught in that, as let's say corrections from speculative stocks eventually will come out, and if they get stuck, it might be difficult to transfer back those funds that move away from the blue chips. So I do hope that we see more profit taking that will come into those issues so that they can remain profitable, and then eventually rotate that amount of funds back into the more significant issues that are lined up into the index. And perhaps after that time, maybe then by that time or after the consolidation's done, that we might see much more viable advances that we might see in the mainline issues. So do be prepared. A controlled correction could come, or a consolidation. I'm looking that resistance is at 7,500 range, or 74 to 76, and pullbacks could be within a range of about 6,700 to maybe 6,400. And I hope within this range would be offering us much better signals to be able to buy back into our market. So with that ends my presentation today. And do stick around so that we can come around and talk about some of the other picks that you've asked us to be able to review. Thank you very much for taking time to be with us in our session. And I hope that I've managed to be able to clarify the technical point of view. Have a good day.
Thank you very much, Juanes. So I guess you also took notes, I hope, because Juanes is just telling us that stocks are somewhere at the overbought area and that the market may consolidate from here over the short term. So he's showing some fatigue, and there the big caps are looking here on the overbought area. So, but what's interesting that I saw in your discussion one is that you compared our market to the German index.
Yeah.
And the German index after the consolidation, there's a jump in the
Yes.
2016 chart that you showed. So we will looking at this correction maybe as an opportunity, but it's not. No, there's no rush, right? There's no rush. We will see this consolidation, and later on after the consolidation, that's the time that we will expect a lot more upside on this.
That's correct.
Thank you very much, Juanes.
All right.